Hey, my name's James Nicholson. Welcome to my YouTube channel. In this video, I'm going to talk about what's the probability of the Federal Reserve cutting interest rates next week. What's also the probability of the Bank of England cutting rates next week? Because let's face it, you're in the UK, you want rates to come down over here because you've probably got a mortgage or you're looking to get one at some point in the near future. Well, in this video, I've got the update on both of those, on what the likelihood of the cuts are here and over the pond in America. Now, before we jump into this, if you're new around here and you haven't done already, do make sure you smash that subscribe button and hit that bell notification. We're on the way to 50,000 subscribers. And by subscribing, you'll get all the latest house price news, interest rate news, property investing news, and much, much more. And let's get some views on this video. Your part's simple. Smash like, tickle like, do something to that like button. That helps with the YouTube algorithm, and that really has helped the channel grow. So thanks to everyone that does that. So, the bank in Europe, the European Central Bank, they held rates today at just 2%. Wouldn't it be nice to be at 2%? Well, not really if you're a saver, but this is a property channel, and I think you guys would all agree that we would like 2% rates, because that would mean mortgages would be significantly more affordable. But we like to be close to the Federal Reserve, and that's why it's important to understand what's going on in America. So let's talk about the Fed first. So the Federal Reserve has got some interesting stuff happening at the moment. And that is that they've got the tariff war in America, and the inflation data is ticking up. So inflation in America went up today to 2.9%, and it's going in the wrong direction. A lot of people are saying, well, these tariffs aren't causing inflation. The thing is, there's a big lag in the data. So the inflation will start to feed through because a lot of people haven't passed on the costs of the tariffs yet. And also, a lot of American businesses bought ahead. They knew the tariffs were likely to come, and so they bought a lot of stock and held it in warehouses. Think of Costco, think of Walmart, these big companies. They plan ahead. They know what they're doing. So they're going and selling items at the moment that are pre the tariffs. And they're running down their stock, hoping that these tariffs get overturned. And if they do, potentially that inflation goes away, and then the Federal Reserve can do something about it. Now, unemployment in America, the same as here, has been rising. They just had a big revision from Biden's time where they took off 1 million jobs from last year, meaning last year they had 77,000 new jobs per month, which is a tiny amount if you think of the size of the country. And this year, they just had 20,000 jobs in the last month, and that often gets revised down. So that could be a negative number when we see that revision in a few months. And so it shows the US economy is in a difficult spot. And so the Federal Reserve has got to make the same decision as the Bank of England. You've got rising unemployment, you've got rising inflation. Now what's more important? Is it more important to deal with the inflation or give maximum employment? Well, the Federal Reserve, I think it's very likely, everyone in the market believes that the Federal Reserve is going to cut between 0.25% and a whole 0.5%. Now, where do I think they're going to go there? I think they're going to go for the 0.25% based off the fact that inflation is still rising. They don't know what the impact of the tariffs is going to be yet. And so I think they're going to take a cautious approach. And that's how they're going to go. And I think it is political a bit now. You've got Donald Trump trying to get rid of Jerome Powell. You've got Jerome Powell saying he won't leave. And so it's very interesting to see how that pans out. So I think you'll get 0.25% next week with the Federal Reserve. What about the Bank of England, though? Because you're British and you want rates to drop here. Well, the Bank of England has a problem on their hands as well. We've got rising inflation, 3.8%, 3.9%. It's likely to tick up to over 4% next week. Not great. That's not good for anybody, is it? And you've also got the fact that retail sales did really well this summer. And that isn't something that we were expecting. So retail sales in August were up 3.1%. And that's been attributed to good weather. And it was a good summer. Like normally in England, we moan about the weather, but we did have pretty good summer this year. And so that meant that people were out and about spending more money. Now, some of that was due to the fact that things were more expensive. And so in the stats, they're talking about, look, we spent more on food, but food was more expensive. That's why we spent more on food. We probably got the same quantity of food, but things were more expensive. And they did say that as well. So the Bank of England's then got to look at what's happening with unemployment. That's rising in the UK. And I believe that that's rising down to government policies like the business rates. They went up. They hit a lot of business. You've got the energy costs. No one's really helping small businesses with energy costs. That's hitting them very, very hard at the moment. And that means that they're having to basically cut back on other stuff. They've got inflation. Their costs of goods is going up. And I think the worst two were the minimum wage going up and the national insurance contribution going up as well. So many small businesses got hit by that, and they're looking to make redundancies and not hire new people. And so that means the Bank of England has to decide now, what do we do? We've got decent retail figures that would say we're not going to cut. You've got inflation that's high and going up. That would say you're not going to cut. But you've also got unemployment, which is increasing and likely to get worse as well. So it's a real balancing act. And I believe, and so does the market, that the Bank of England this month will hold. And most people feel that they will hold all the way through until December this year. They think there'll be one more cut. Now, that would give them multiple times to get more GDP data, more unemployment data, more inflation data, and then give us a nice little Christmas present at the end of the year. And that would really help us. Now, what does that mean for your mortgage rate? Because you don't really care what the Bank of England rate is. You care what your lender lends at. Now, right now, rates have been going up. They've been going up with a lot of lenders, and the average rate at the moment has gone up this week. And that's down to the fact that the rate that they borrow at, the SONIA swap rate, that's been going up because there isn't many Bank of England cuts forecast. And so having that problem means that it's more expensive for HSBC, for NatWest, Nationwide, Halifax, more expensive for these guys to get money and lend it to you at the moment. So the only way you're going to see rates drop, which we have seen with places like Halifax, is if they cut their margins because they want to get more business at certain times. And they have done that. But the majority of lenders right now are either holding rates or increasing rates at the moment. Now, if you've got a mortgage that expires in the next 6 months, here's my suggestion to you. I would contact your broker or contact your lender and get a rate agreed now. What that gives you is your worst case scenario. So let's just say you call your bank and they give you a rate of 4%. What if rates go up in that 6 months, 4 months, 2 months, whatever, however many months you've got till your new deal starts? If rates go up to 5%, you're okay. You've locked in your worst case scenario. However, if there's suddenly a crash in rates and things go down, you can then swap before you start the new deal. It has to be before you start the new deal. You can swap onto those lower rates. That gives you the worst case scenario locked in. And lots of people have done that this year and saved a ton, including thousands of people that watch this channel that have commented saying thanks, and they've done that and that's helped them. So do make sure you share this video and tell people to watch to the end to find out how to save some money on your mortgage. So yeah, we've got the Fed likely to cut next week, 90% certainty. The Bank of England, 90% certainty to hold. That's what I think is going to happen. What do you think is going to happen? Let me know in the comments. And the last thing, there's a few days left of the fundamentals of property investing is just £20 at the moment. What does that mean for you? Well, that means that we'll teach you all the fundamentals of being a property investor, like finding deals below market value. That allows you to build instant equity in that property. We'll also teach you how to add value to the property. That's important. Is it new kitchens, new bathrooms, new bedrooms? That stuff adds instant equity to your property. It can be done very, very cost effectively, and that really is a great way to make some good money and protect yourself should the market downturn. We then need to look at how do you cash flow this property. Look, let's be honest, normal buy-to-let's tough at the moment. So you've got to look at high cash flow strategies like serviced accommodation, like HMOs, like student accommodation, like using the BRRR strategy, buy, refurbish, refinance, rent. Well, all of that is included in 100 videos for £20 one-time charge. More than 2,000 people watching this channel now have invested in that over the last few years. It's a one-time purchase. Any updates, you get those for free as well. So click in the description and click in the first comment and grab a copy of that while you're here. Do also check out all the other content as well on the channel, including this video right here.